Ever wonder how professional traders look at a screen and predict whether a stock will move up or down in the next 60 seconds? It is absolutely not magic, and it is rarely blind luck. They are simply reading the visual language of stock charts. This chart shows the most basic unit of that language, the candlestick. When you see a green candle form, it means the price is moving upward. Traders call this a bullish trend. A red candle shows the exact opposite. The price is dropping, indicating a bearish trend. Sometimes the market doesn't make any major vertical jumps or drops. It just drifts. We call this flat alternating pattern sideways movement. Memorizing these individual color blocks is step one. The actual skill comes from recognizing the architectural boundaries these blocks build over time. When we zoom out, notice how the falling price hits a bottom level and bounces back up. This floor is called support. Conversely, a rising market hitting an upper boundary gets pushed back down. This ceiling is resistance. These two lines give you a map of the current price action. But to decide exactly when to buy or sell, traders rely on mathematical confirmation. We use technical indicators. If support and resistance show us exactly where the battle is taking place, technical indicators help us predict who is going to win it. The Relative Strength Index, or RSI, tracks market momentum. When the number dips below 30, the asset is oversold and likely to bounce up. Conversely, climbing past 70 means it's overbought, and the price will likely drop. The exponential moving average, or EMA, has a strict visual rule. A blue EMA line sitting directly above the price candles indicates a downward trend. When it weaves underneath, it acts like a ramp, signaling an upward trend. For a simpler visual cue, traders use the supertrend indicator. A descending red line predicts a fall. An ascending green line predicts a rise. Let's test this. Take a look at this chart. We have a red candle, a red supertrend line, and an RSI reading of 78. What happens next? The market is highly likely to experience a downtrend. You have 3 separate data points confirming the exact same bearish drop. By stacking these indicators together, traders remove emotional guessing from the equation. They build a calculated matrix of probability. This chart shows what happens when we pull back from the minute-by-minute noise. Switching to a 5-minute interval allows you to verify the overall long-term trend, keeping you from getting faked out by tiny temporary price spikes. Note that these indicators provide predictions based on historical patterns, not absolute guarantees. The market can, and occasionally will, defy the data. Here is a consolidated cheat sheet covering every rule we just broke down. Grab a screenshot and keep it open as a reference for your own practice. Mastering these visual tools will not make you wealthy overnight, but it does take the chaotic, random noise of the stock market and turns it into a readable, actionable language.